As we enter the second half of the year, investors continue to be grappling with high inflation, rising interest rates, and are keenly watching how central banks navigate the current environment with a growing concern of a higher probability of a recession. If historical bear markets are any indication, the decisions that investors make during these periods will have long-lasting effects on their portfolios. We have seen a huge amount of market volatility. The daily market swings are fatiguing, even for the most experienced investors. Some clients may even be tempted to sit on the sidelines. However, history tells us that market recoveries can occur when investors least expect it. So it's important that we are building portfolios that are mindful for the market conditions that we are currently facing, but that are ultimately positioned for the years ahead. What has made this year challenging is that both bond and equity markets have sold off and performed poorly. This is because inflation surprised markets and policymakers have been forced to raise interest rates hard and fast to bring inflation back under control. Rising interest rates has led to some of the largest losses ever seen in bond markets and a general repricing of risk across all asset classes. In effect, to date, the bond market volatility has caused equity market volatility. A number of key equity markets, including the S&P 500, are now in official bear market territory, having sold off more than 20% year to date. Despite the market sell-offs, however, markets are still not cheap. Using the US as an example, it is trading on a cyclically adjusted PE ratio of 31.2 versus a long-run average of 24.3. So while this market sell-off is certainly painful for investors, we're still not seeing huge valuation opportunities at the moment that we can take advantage of in your portfolio. The inflation story has evolved over the last year. COVID shutdown saw businesses shut down, leading to supply chain disruptions. Most governments, fearing a GFC-like recession, injected fiscal stimulus into economies that were already juiced up on low interest rates. This led to an increase in demand for goods as people moved to shopping online to pass the time in lockdown. The mismatch in demand and supply led to higher prices, which was escalated further when sanctions were levied against Russia following the Ukraine invasion. Today, particularly in the US, the concern is wage inflation. Inflation driven by wages is more concerning than simple supply and demand imbalances. This is because the only way to get wage inflation under control is by raising interest rates and deliberately slowing the economy. Interest rate forecasts for advanced economies imply that we are set for the most aggressive and synchronized tightening cycle in around 3 decades. Markets are concerned that any policy misstep could lead to a recession. Wage inflation in the US is currently at 6.4%, while core inflation is only 6%. Labor is one of the major input costs to most businesses. It can be up to 80% of the input costs in some industries. So one of two things is likely to happen from here. Companies pass on the higher input costs in the form of higher prices, and core inflation continues to rise. This would put pressure on central banks to keep hiking rates. Or companies absorb the input cost increases, leading to margin squeeze. So this company reporting season will likely see further volatility as markets are hopeful for positive outcomes, with analysts still expecting earnings growth for this calendar year. And therefore any misses or any negative guidance is likely to be punished. At the moment, it doesn't appear as though the market is actually pricing in the margin pressures that businesses are likely to be feeling during this period of inflation. As the economy responds to inflation pressures, investors continue to struggle with daily price swings across markets. This level of market volatility is disorientating even for the most experienced investors. Some investors may be tempted to hide in cash during times of market stress. However, in inflationary environments, this is perhaps the worst time to do so. This is because inflation, by its very definition, erodes the value of cash. Experienced investors know that bear markets occur periodically and are an important part of market cycles. For patient and experienced investors, these periods actually present opportunities to invest when valuations are attractive. Focusing on valuation is the best tool investors have to gauge the attractiveness of markets over years and decades. This is the focus of our process. Focusing on valuations will lead us to take positions in assets where the market, who is focused on the short-term macro concerns, has led to the asset trading below its long-term fundamentals. It is the decisions we make in these market conditions that will set the portfolios up for long-term success. After all, the reason investors are rewarding in the long run for taking risk is their willingness and ability to stomach short-term uncertainty.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.